Hi, I'm John Stevenson, the Guaranteed Retirement Guy. Today we're going to be talking about what to do if you inherit a non-qualified annuity contract. So non-qualified annuities are different than qualified. Obviously, if you inherit an IRA that has an annuity contract, you have to take it out over 10 years. Okay, the rules are very clear for IRAs, and of course, it's different if you're a spouse. But let's talk about non-qualified annuities because, if you have maybe a sibling or a parent or a friend who left behind a non-qualified annuity, outside of an IRA, then that's something you're going to be taxed on if there are earnings inside of it. So there are certain things to consider. And you have different options. You can't completely avoid taxes, okay? You're going to be paying them. It just depends on how you want to take them out, okay? So with non-qualified annuities, you can either take it all out and pay taxes upfront, or you can stretch it out over 5 years. They do have the option where if you just want to take it out over a 5-year plan, it just spreads it out a little bit, which is nice. And of course, you're only being taxed on the earnings. So for instance, if the person who is deceased purchased that annuity with $300,000, and let's say the money that is in that account when it passes to you is $400,000, then of course, as you take that money out, you're going to be taxed on $100,000, not on the $300,000 that is the basis for that contract. Okay, so that's good to remember. Or you can also just wait at the end of 5 years and just take all of it out at that time. So you can defer it. You're just going to be you're being taken a huge tax hit when you take all that money out at that time. Now, if you're a spouse and your other spouse was receiving income, then you can elect to continue those income payments as long as it is joint income. Okay, so that has to be selected before your spouse who is now deceased took their income. Okay, so if it's a single payout, then you're just going to get the proceeds of whatever is left in the account balance. Okay, so that's always a good thing to remember if you are looking for a guaranteed lifetime income. You want to set it up, especially if you're married, usually as a joint payout. Okay, so think about that. Of course, everyone's different, and different needs necessitate different income streams. A single payout versus a joint payout, both are good. Sometimes one spouse has enough assets to cover themselves, if their spouse dies. And so in that case, sometimes a single payout would work. Now, if you decide that you want to take, you're the spouse and your significant other died and you want to just take the proceeds out, you can totally do that. You will still be taxed though on the earnings, okay? Not on the cost basis, not on the original amount that was invested. Of course, you'll never be taxed on that. But if you want to just keep on taking the payments, then of course you'll continue to take that income as before. Now, another thing you can do, especially if you receive a non-qualified annuity, maybe from your parents, and you don't need the income, but you don't really want to take all of that money out and get taxed on it right now, you can always do a 1035 exchange into another annuity contract. So it has to be something similar as the one that you inherited. Okay, so remember that. And that's the nice thing about annuities. Non-qualified annuities, they give you the same tax deferral benefits that an IRA will give you. So that's nice. So if you want to take that tax hit later, maybe you want to defer that 5-10 years down the road, then you can certainly do that. You could just take that money and 1035 it into another annuity contract, defer the taxes, have some more growth, and then at a later time, maybe convert that to lifetime payments or just take the money out and be taxed on it. So you have those options. And speaking of lifetime payments, yes, if you inherit a non-qualified annuity, you can convert that to lifetime payments. It's called a stretch, okay? A non-qualified stretch annuity, basically what they do is they will use your life expectancy and they will give you income for the rest of your life. There's also a lifetime income option that is not a stretch and it is not based off your life expectancy. So there are different options available to you. And it would make sense if you have one of these that you inherit and you're thinking about maybe putting it into another annuity contract, but you're not sure which one to choose. then it's a good idea to book a call with an expert like myself, and we'll go over all of the top annuity options. Now, if it's a fixed annuity, maybe it's a MIGA that you're looking for, just a fixed rate, that's great. If you're looking for income and you want the highest income possible, I'll show you everything. Okay, just book a call on my calendar. You'll see a link below this video where you can actually get into my calendar and we'll chat. Okay, and I'm not going to try to sell you anything, but I will show you everything that is available. And of course, I'd love to help you get into an annuity contract if that's something that makes sense for you. Okay, I'd love to help you with that. So anyways, I hope this video brought some value. And if it did, I hope that you will like and subscribe, and so that you can see all the rest of the videos that I create on a regular basis. So thanks again for watching, and we'll see you in the next video.